Welcome to the Full-Time Hustler Podcast. I'm your host, Jason Feimster, and today we're delving into a crucial topic for every entrepreneur out there, financial literacy. Understanding your numbers is not just about keeping the lights on. It's about making informed decisions that propel your business forward. In this episode, we'll break down financial statements, explore key metrics, and discuss strategies for managing cash flow, budgeting, and much more. Whether you're just starting out or looking to refine your financial knowledge, this episode is packed with insights to help you master your business finances. Today, we're diving into the foundation of every entrepreneur's financial understanding, basic financial statements. Now, I know this might not sound like the most thrilling topic, but stick with me. Understanding these statements is like having a superpower in your entrepreneurial toolkit. So let's kick things off with the income statement. This little gem is sometimes called the profit and loss or P&L. Think of it as your business's report card. It shows you the revenue you've earned and the expenses you've incurred over a specific period. The bottom line, it tells you whether you've made a profit or a loss. But here's where it gets interesting. The income statement doesn't just tell you if you're making money. It tells you where your money is coming from and where it's going. You can see your sales revenue, the cost of goods sold, your gross profit, operating expenses, and finally your net profit. This breakdown helps you understand your business's financial health and identify areas for improvement. For example, if your operating expenses are eating up most of your revenue, it's time to trim the fat. Next up, we have the balance sheet. Imagine this as a snapshot of your business's financial position at a specific point in time. It's divided into three main sections: assets, liabilities, and equity. Your assets are what your business owns: cash, inventory, property, and equipment. Liabilities are what your business owes: loans, accounts payable, mortgages. Equity is the difference between your assets and liabilities, basically what's left over for the owners after all debts are paid. The balance sheet is crucial because it gives you a clear picture of your business's financial strength. Are you heavily in debt? Do you have enough assets to cover your liabilities? Understanding this can help you make smarter decisions about financing and growth. And finally, let's talk about the cash flow statement. This one tracks the flow of cash in and out of your business over a period of time. It's broken down into three sections: operating activities, investing activities, and financing activities. Operating activities show the cash generated from your core business operations. Investing activities reflect cash used for investment in assets like property or equipment. Financing activities detail the cash transactions related to borrowing and repaying loans or equity financing. Why is the cash flow statement so important? Because cash is king. You might have heard stories of profitable businesses going bankrupt because they ran out of cash. This statement helps you keep track of your liquidity, making sure you have enough cash on hand to meet your obligations and invest in opportunities. Understanding these three financial statements, income statement, balance sheet, and cash flow statement, is essential for making informed decisions, attracting investors, and steering your business toward success. They provide a comprehensive view of your business's financial health, allowing you to plan for growth, identify potential issues before they become critical, and demonstrate your financial acumen to potential investors and partners. So, full-time hustlers, don't be intimidated by these financial documents. Embrace them, dive into them, and use them to your advantage. Mastering your numbers is not just about keeping the IRS happy or securing a loan. It's about taking control of your business destiny. Stay tuned, because next up we're diving into key financial metrics every entrepreneur should know. Let's talk about key financial metrics that every entrepreneur should have at their fingertips. These metrics are like the vital signs of your business, giving you insights into its health and performance. First on our list is the gross margin. This metric tells you how much money you're making from selling your goods or services after subtracting the cost of producing them. To calculate it, take your total revenue and subtract the cost of goods sold, or COGS. Then divide that number by your total revenue. The result is a percentage. A higher gross margin means you're keeping more money from each dollar of sales, which is crucial for covering your operating expenses and generating profit. Next, let's dive into the net profit margin. This one goes a step further than the gross margin by considering all of your business expenses, not just COGS. To calculate it, take your net profit and divide it by your total revenue. Again, you get a percentage. This metric shows how much of each dollar earned is actual profit. A low net profit margin might indicate high expenses or pricing issues, whereas a high net profit margin shows efficiency and effective cost management. Now let's talk about EBITDA, earnings before interest, taxes, depreciation, and amortization. EBITDA is a measure of your business's overall financial performance and is often used as an alternative to simple earnings or net income. It strips out the effects of financing and accounting decisions, providing a clearer view of your operational profitability. To calculate EBITDA, start with your net income and add back interest, taxes, depreciation, and amortization. This metric is particularly useful for comparing your business's performance with others in your industry, as it removes the impact of capital structure and tax rates. Another crucial metric is the current ratio. This one helps you assess your business's ability to pay its short-term obligations. To calculate it, divide your current assets by your current liabilities. A ratio above 1 indicates that your business has more assets than liabilities, meaning you're in a good position to cover your short-term debts. However, a ratio that's too high might suggest that you're not effectively using your assets to grow the business. Debt to equity ratio is another key metric to keep an eye on. This ratio measures your business's financial leverage by comparing your total liabilities to your shareholders' equity. To calculate it, divide your total liabilities by your total equity. A lower ratio indicates that your business is using less debt to finance its operations, which is generally seen as a positive sign. However, leveraging some debt can be beneficial for growth, so it's about finding the right balance. Finally, let's discuss the return on investment, ROI. ROI measures the profitability of your investments. To calculate ROI, subtract the initial investment cost from the final value of the investment. Then divide that number by the initial investment cost. The result is expressed as a percentage. ROI helps you evaluate the efficiency of your investments, whether they're in marketing, new equipment, or any other area of your business. A higher ROI means you're getting more bang for your buck. Understanding and tracking these key financial metrics will give you a comprehensive view of your business's performance. They'll help you make informed decisions, identify areas for improvement, and communicate your business's health to potential investors and stakeholders. In the next segment, we'll tackle cash flow management, a critical area that can make or break your business. Stay with me as we delve into strategies to keep your cash flow healthy and robust. Cash flow management is the lifeblood of any business. It's what keeps the wheels turning, ensuring you have enough money to cover your expenses, invest in growth, and weather any financial storms that come your way. Let's break it down into manageable parts and explore strategies to keep your cash flow healthy and robust. First, let's talk about the importance of monitoring your cash flow regularly. Think of this as taking your business's pulse. By keeping a close eye on the inflow and outflow of cash, you can spot potential problems before they become crises. Use tools like cash flow statements, which we've discussed earlier, to get a clear picture of your liquidity. Many accounting software programs like QuickBooks or Xero offer built-in cash flow management features that can simplify this process. Now let's dive into some strategies to improve your cash flow. One of the most effective ways is to accelerate your receivables. This means getting your customers to pay you faster. You can achieve this by offering early payment discounts, invoicing promptly, and setting clear payment terms. Make sure your invoices are easy to understand and provide multiple payment options to reduce friction. Another crucial strategy is managing your payments wisely. While it's important to pay your bills on time, to maintain good relationships with suppliers, don't pay them too early. Take advantage of the full payment terms provided to you. This gives you more time to hold onto your cash, which can be particularly useful in tight periods. Inventory management is another area where you can significantly impact your cash flow. Holding too much inventory ties up your cash unnecessarily. Use inventory management systems to track stock levels and optimize your inventory turnover. This ensures you're only holding as much inventory as you need, freeing up cash for other uses. Let's not forget about the role of pricing in cash flow management. Regularly review your pricing strategy to ensure it reflects the value you're providing and covers your cost. If you're not pricing your products or services correctly, you might be missing out on potential revenue. Conduct market research to understand what your customers are willing to pay and adjust your prices accordingly. Cost control is another vital aspect. Review your expenses regularly and look for areas where you can cut costs without compromising the quality of your product or service. This could involve negotiating better terms with suppliers, reducing overhead costs, or finding more cost-effective ways to operate. Finally, consider external financing options to boost your cash flow. Lines of credit, business loans, or even factoring can provide the liquidity you need to bridge gaps between receivables and payables. However, use these options judiciously and ensure you understand the terms and cost involved. In summary, effective cash flow management involves a combination of monitoring, strategic planning, and proactive decision making. By accelerating receivables, managing payables wisely, optimizing inventory, receiving and reviewing pricing strategies, controlling costs, and considering external financing, you can ensure your business has the cash it needs to thrive. Budgeting and forecasting are essential tools for any entrepreneur aiming to steer their business toward long-term success. Let's delve into these concepts and explore how they can help you manage your finances more effectively and plan for the future. First, let's start with budgeting. A budget is essentially a financial plan for your business, outlining your expected income and expenses over a specific period, typically a year. Creating a budget helps you allocate resources, control costs, and ensure that you have enough funds to meet your financial obligations and invest in growth opportunities. To create an effective budget, start by estimating your revenue. Look at your historical sales data. Consider current market conditions and account for any seasonal trends that might affect your business. Be realistic but optimistic. You want to challenge yourself to grow while remaining grounded in reality. Next, list all your expected expenses. These can be divided into fixed costs like rent and salaries, which remain constant, and variable costs like utilities and raw materials, which can fluctuate. Don't forget to include one-time expenses such as equipment purchases or marketing campaigns, and set aside a contingency fund for unexpected costs. Once you have your revenue and expense estimates, subtract your total expenses from your total revenue to determine your net income. If your expenses exceed your revenue, you'll need to find ways to cut costs or increase income. This might involve negotiating contracts, finding cheaper suppliers, or boosting your marketing efforts to drive more sales. Now let's move on to forecasting. While budgeting provides a roadmap for your finances, forecasting helps you predict future financial performance based on current trends and data. It's a dynamic process that involves regularly updating your predictions to reflect new information and changing circumstances. There are several types of forecasts you can use, but the most common ones are short-term, medium-term, and long-term forecasts. Short-term forecasts, typically covering 1 to 3 months, focus on immediate financial needs and cash flow management. Medium-term forecasts, covering 6 months to a year, help you plan for upcoming projects and expenses. Long-term forecasts, spanning several years, provide a strategic view of your business's growth and development. To create a forecast, start by gathering historical financial data, including sales, expenses, and cash flow. Analyze this data to identify patterns and trends that can help you predict future performance. Use tools like Excel or financial forecasting software to create detailed projections, adjusting your assumptions as needed to account for changes in the market, industry, or economy. Forecasting isn't just about predicting numbers, it's about planning for different scenarios. Create multiple forecasts based on best case, worst case, and most likely scenarios. This will help you prepare for a range of outcomes and make informed decisions no matter what the future holds. Incorporating budgeting and forecasting into your financial management routine can provide numerous benefits. They help you set realistic financial goals, allocate resources effectively, and identify potential issues before they become critical. They also provide valuable insights that can guide your strategic planning and decision-making processes. In conclusion, budgeting and forecasting are powerful tools that can help you take control of your finances and set your business on the path to success. By creating detailed budgets and regularly updating your forecasts, you can ensure that you're always prepared for whatever comes your way. Understanding business credit is crucial for any entrepreneur looking to secure financing and build a solid financial foundation for their business. Business credit can affect your ability to get loans, lease office space, and even secure favorable terms with suppliers. Let's dive into what business credit is, why it's important, and how you can build and maintain a strong business credit profile. Business credit is essentially your company's financial reputation. Just like personal credit, it reflects your business's ability to repay debts and manage finances responsibly. Lenders, suppliers, and even potential business partners use your business credit score to assess your credit worthiness. A strong business credit score can open doors to better financing options, lower interest rates, and more favorable terms, while a poor score can limit your opportunities and increase your costs. To start building business credit, the first step is to separate your business and personal finances. This means establishing your business as a separate legal entity, such as an LLC or corporation. Open a dedicated business bank account and obtain a business credit card. Use these accounts exclusively for business expenses to create a clear financial distinction between you and your business. Next, make sure your business is registered with the appropriate credit reporting agencies. The three major business credit bureaus in the U.S. are Dun & Bradstreet, Experian Business, and Equifax Business. Obtain a DUNS number from Dun & Bradstreet, as this will be used to identify your business in their credit reporting system. Regularly review your business credit reports from these agencies to ensure accuracy and address any discrepancies promptly. Building business credit involves establishing a history of responsible credit use. Start by applying for credit with vendors and suppliers that report to the business credit bureaus. Pay your bills on time, or even early, to demonstrate reliability. As you build a positive payment history, your business credit score will improve. Managing your debt levels is also crucial. Keep your credit utilization ratio low, ideally below 30%. This means using only a small portion of your available credit at any given time. High credit utilization can negatively impact your credit score and signal financial instability to potential lenders. It's also important to regularly update your business information with the credit bureaus. Ensure that your business name, address, and other details are current. Inaccurate or outdated information can lead to discrepancies in your credit reports and potentially lower your score. Another key aspect of maintaining strong business credit is monitoring your credit regularly. Sign up for credit monitoring services offered by the major business credit bureaus. These services can alert you to any changes in your credit profile, such as new accounts or inquiries, and help you detect potential fraud early. Finally, consider seeking professional advice if you're unsure about managing your business credit. Financial advisors or credit counseling services can provide valuable insights and strategies tailored to your specific situation. They can help you navigate complex financial decisions and improve your credit profile over time. Building and maintaining strong business credit takes time and effort, but the benefits are well worth it. A solid credit score can enhance your business's financial flexibility, provide access to better financing options, and ultimately support your growth and success. Financial planning and analysis, or FP&A, is a crucial function for any entrepreneur aiming to drive business growth and make informed decisions. FP&A involves forecasting future financial performance, analyzing business trends, and providing insights that support strategic planning. Let's explore how you can implement effective FP&A practices in your business to enhance your decision making and overall success. First, let's define what FP&A entails. At its core, FP&A is about developing financial plans and analyzing past performance to inform future strategies. It involves creating detailed financial models that forecast revenue, expenses, and profitability. These models help you understand the potential impact of different business scenarios and guide your strategic planning. The FP&A process starts with setting clear financial goals. These goals should be specific, measurable, achievable, relevant, and time-bound. SMART. Whether you aim to increase revenue by 20% in the next year, reduce operating costs by 10%, or achieve a certain profit margin, having clear goals will help give you a roadmap to follow and benchmarks to measure your progress against. Next, you'll need to gather and analyze data. This includes historical financial data, market trends, and economic indicators. Use this data to create financial forecasts that project your future financial performance. There are various tools and software available that can help you with this, such as Excel, Anaplan, and Adaptive Insights. These tools allow you to build sophisticated financial models and perform scenario analysis. Scenario analysis is a key component of FP&A. It involves creating different financial scenarios based on various assumptions and assessing their impact on your business. For example, you might create a best case, worst case, and most likely scenarios for your revenue growth. This helps you prepare for different outcomes and make more informed decisions. By understanding how changes in market conditions, customer behavior, or internal operations can affect your financial performance, you can develop strategies to mitigate risk and capitalize on opportunities. Regularly reviewing your financial performance is another critical aspect of FP&A. Compare your actual results against your forecasts and budgets to identify variances. Analyzing these variances helps you understand why certain goals were not met or exceeded, and what actions you can take to improve future performance. For instance, if your sales are constantly below forecast, it might indicate a need to adjust your marketing strategy or product offerings. FP&A also involves strategic planning. Use the insights gained from your analysis to inform your strategic decisions. This could involve making investment decisions, expanding into new markets, launching new products, or implementing cost-saving initiatives. The goal is to align your financial plans with your business strategy, ensuring that your financial resources are allocated effectively to achieve your long-term objectives. Communication is key in FP&A. Ensure that your financial insights and recommendations are clearly communicated to your team and stakeholders. Use visual aids like charts, graphs, and dashboards to make complex data more understandable. Regular financial reviews and meetings can help keep everyone aligned and focused on the same goals. Lastly, embrace technology to enhance your FP&A processes. Modern FP&A software offers advanced features like predictive analytics, machine learning, and real-time data integration. These tools can provide deeper insights and streamline your financial planning and analysis, making your processes more efficient and accurate. In summary, effective FP&A involves setting clear financial goals, gathering and analyzing data, performing scenario analysis, regularly reviewing performance, informing strategic planning, and leveraging technology. By implementing robust FP&A practices, you can make more informed decisions, drive business growth, and navigate the complexities of entrepreneurship with greater confidence. Tax planning is a critical aspect of financial management for entrepreneurs. It not only helps you comply with tax laws, but also enables you to maximize your tax or minimize your tax liability and maximize your business's profitability. Let's explore some essential tax planning strategies that every entrepreneur should know. First and foremost, understand the different types of taxes that can affect your business. These may include income tax, payroll tax, sales tax, and self-employment tax, among others. Each type of tax has its own set of rules and deadlines, so it's crucial to stay informed and organized. The IRS website is a valuable resource for understanding federal tax obligations, while your state's tax authority can provide information on state-specific taxes. One of the most effective tax planning strategies is to keep meticulous records. Accurate and organized financial records not only make it easier to prepare your tax returns, but also ensure that you can substantiate any deductions or credits you claim. Use accounting software like QuickBooks or Xerox to track your income expenses. And consider hiring a professional bookkeeper if your business finances are complex. Speaking of deductions, take full advantage of the tax deductions available to your business. Common deductions include expenses for office supplies, travel, marketing, and home office expenses if you work from home. The key is to ensure that these expenses are ordinary and necessary for your business. Keeping detailed receipts and documentation is essential to substantiate your deductions if you are ever audited. Another important strategy is to consider the structure of your business. Different business structures have different tax implications. For instance, sole proprietorships, partnerships, S corporations, and C corporations each have unique advantages and disadvantages when it comes to taxes. Consulting with a tax professional can help you choose the most tax-efficient structure for your business. Retirement planning can also play a significant role in your tax strategy. Contributions to retirement plans such as SEP IRA, Simple IRA, or 401k not only help you save for the future, but can also reduce your taxable income. These plans offer various tax benefits, including tax-deferred growth and potential tax deductions for your contributions. Additionally, be mindful of the timing of your income and expenses. Accelerating expenses and deferring income can help you lower your tax liability for the current year. For example, if you expect your business income to increase next year, you might choose to defer billing clients until after the new year or prepay expenses before the year ends. This strategy requires careful planning and consideration of your overall financial situation. Tax credits are another powerful tool in your tax planning arsenal. Unlike deductions, which reduce your taxable income, tax credits reduce your tax liability dollar for dollar. Examples of valuable tax credits for businesses include the Research and Development Tax Credit, the Work Opportunity Tax Credit, and various energy efficiency credits. Make sure to explore all the credits for which your business might qualify. Working with a tax professional, such as a certified public accountant or enrolled agent, can be invaluable. These experts stay up to date with the latest tax laws and regulations and can provide personalized advice to optimize your tax situation. They can also help you navigate complex tax issues and represent you before the IRS if necessary. In conclusion, effective tax planning involves understanding your tax obligations, keeping detailed records, maximizing deductions and credits, considering your business's structure, planning for retirement, timing your income and expenses, and consulting with tax professionals. By implementing these strategies, you can minimize your tax liability and ensure that more of your hard-earned money stays in your business. In our next segment, we'll dive into financial decision making. We'll explore how to make informed decisions that drive your business forward using data, analytics, and strategic planning. Financial decision making is at the heart of every successful business. It involves analyzing data, evaluating options, and making choices that align with your strategic goals. Let's explore the key aspects of making sound financial decisions that can drive your business forward. First, understand the importance of data-driven decision making. In today's business environment, relying on gut feelings or intuition is not enough. You need to base your decisions on solid data. This means collecting and analyzing financial data regularly. Use tools like financial statements, KPIs, and dashboards to get a clear picture of your business's financial health. Financial software such as QuickBooks, Xerox, or more advanced solutions like SAP and Oracle can provide real-time insights into your financial performance. When making financial decisions, always consider the cost-benefit analysis. This involves comparing the cost and benefits of different options to determine which provides the best return on investment. For example, if you're considering a new marketing campaign, calculate the expected increase in revenue against the cost of the campaign. If the benefits outweigh the cost, it's a good decision. Another critical aspect is understanding the concept of opportunity cost. This is the cost of foregoing the next best alternative when making a decision. For instance, if you invest in new equipment, the opportunity cost might be the other projects or investments you can't pursue as a result. Always weigh these alternatives carefully to ensure you're making the most strategic use of your resources. Risk management is also a vital part of financial decision making. Every decision carries some level of risk, so it's essential to identify, assess, and mitigate these risks as much as possible. This might involve diversifying your investments, purchasing insurance, or setting aside contingency funds. Tools like SWOT analysis, assessing strengths, weaknesses, opportunities, and threats, can help you understand potential risk and opportunities. Scenario planning is another powerful tool. This involves creating different scenarios based on various assumptions and analyzing their potential impact on your business. For example, consider how changes in market conditions, customer behavior, or regulatory environments might affect your financial performance. By preparing for different outcomes, you can make more resilient decisions. Cash flow considerations should always be top of mind. Even profitable businesses can struggle if they run out of cash. Ensure that your decisions support healthy cash flow. This might mean delaying certain expenditures, securing credit lines, or optimizing your receivables and payables. Engaging with stakeholders is crucial in the decision-making process. This includes your team, investors, and even customers. Gather input from those who will be affected by the decisions and those who have valuable insights. This collaborative approach can provide different perspectives and lead to more balanced and informed decisions. Benchmarking is another useful strategy. Compare your financial metrics with industry standards or competitors to see how you stack up. This can highlight areas where you're excelling and areas that need improvement. It can also inspire new ideas and strategies for growth. Finally, always evaluate the impact of your decisions after implementation. This involves comparing the actual results with your projections and analyzing any variances. This post-decision analysis helps you learn from your experiences, refine your decision-making processes, and improve future outcomes. In summary, effective financial decision-making involves gathering and analyzing data, conducting cost-benefit and opportunity cost analysis, managing risk, planning for different scenarios, considering cash flow, engaging stakeholders, benchmarking against industry standards, and evaluating outcomes. By mastering these skills, you can make decisions that propel your business toward success. Stay tuned for the conclusion, where we'll wrap up our discussion on financial literacy for entrepreneurs and highlight the key takeaways from today's episode. As we wrap up today's episode on financial literacy for entrepreneurs, let's take a moment to reflect on the key takeaways. We've covered a lot of ground, from understanding basic financial statements and key financial metrics to mastering cash flow management, budgeting, forecasting, tax planning, and making informed financial decisions. Each of these elements plays a vital role in building a solid financial foundation for your business. First, we delved into the importance of understanding your financial statements. The income statement, balance sheet, and cash flow statement are not just numbers on a page. They tell the story of your business's financial health and performance. By mastering these documents, you can make better decisions, spot potential issues early, and steer your business towards profitability. Next, we explored key financial metrics that help you gauge your business efficiency and success. Metrics like gross margin, net profit margin, EBITDA, and current ratio provide critical insights into your financial operations and help you benchmark your performance against industry standards. We then discussed the lifeblood of your business, cash flow. Effective cash flow management ensures that you have enough liquidity to meet your obligations and invest in growth opportunities. Strategies such as accelerating your receivables, managing payables, and optimizing inventory are essential to keeping your cash flow healthy. Budgeting and forecasting were our next topics. These processes allow you to plan for the future, allocate resources efficiently, and prepare for different scenarios. A well-crafted budget and accurate forecasts are your roadmaps to achieving your financial goals and navigating the uncertainties of business life. In our segment on understanding business credit, we highlighted how a strong credit profile can open doors to better financing options and favorable terms. Building and maintaining good business credit involves separating personal and business finances, keeping meticulous records, and regularly monitoring your business credit reports. Tax planning is another critical aspect we've covered. By taking full advantage of deductions, choosing the right business structure, planning for retirement, and working with tax professionals, you can minimize your tax liability and keep more of your hard-earned money in your business. Lastly, we delved into the art of financial decision-making. Data-driven decisions, cost-benefit analysis, risk management, scenario planning, and engaging stakeholders are all crucial elements that help you make informed choices that align with your business strategy. Financial literacy is not just about understanding numbers. It's about using that understanding to make smart strategic decisions that drive your business forward. As entrepreneurs, we face many challenges, but with the right financial knowledge and tools, we can turn those challenges into opportunities. Keep honing your financial skills. Stay curious and never stop learning. Thank you for joining me today on this journey into the financial literacy for entrepreneurs. I hope you found this episode insightful and empowering. Remember, mastering your finances is a journey, not a destination. Keep hustling, keep thriving, and stay tuned for our next episode where we'll dive into another essential topic for your entrepreneurial success. This is Jason Feimster, signing off for Full-Time Hustler. Until next time, keep pushing forward, keep learning, and keep tuning your entrepreneurial dreams into reality.